All right. Welcome, one and all.
Hi, everybody. Welcome to the pre-show.
Us at our best. Here we go. And going live on Facebook as well.
Great. Welcome, everybody.
Welcome to the public.
Yeah, welcome everybody who's tuning in on Facebook Live, and welcome to all of you tuning into the webinar on Zoom, and welcome to all of you who are listening to this after the fact, either on the podcast or on our YouTube channel. We try to get this out in lots of different formats. We know that people, kind of consume information, consume stuff like this in different places. So if you're here, that's good.
Absolutely.
You found us. That's great.
Welcome to it. There we go. So we have a couple slides to go over today, right? But
We
in
do.
general, we're always keeping an eye on things, and there always seems to be some markers out there that say, hey, this is when volatility kind of reaches its right
Yeah,
uh-oh
yeah,
point
yeah. The
or
VIX, I mean, it's kind of the official, Wall Street uh, index basically for volatility. And I think most people have flown on an airplane before, and we did our market forecast here a couple of months ago. But most people have flown on an airplane. In fact, I was just talking to a client the other day. They just got back from an epic trip. This is kind of an epic retirement celebration trip. Literally flew all the way around the world. It was 10 different flights. They ended up going to the Middle East and Africa and Australia, New Zealand, a lot of places. And
wow.
but I asked him, I said, of those 10 flights, how many of those was there zero turbulence? And he said, none. I mean, you're going to always experience that as an investor, right? You're going to
Never
experience the
fail.
turbulence of the market. Well,
Absolutely.
yeah. What are some of the questions you've been hearing from people over the last, 5 weeks or so? That's kind of when the stuff with
Yeah.
Iran and a lot of the volatility ticked up.
Yeah, I would say, it's kind of your standard stuff. It's hard not for people not to get emotional about their money,
Yeah.
right? Which is a big purpose why we have jobs,
Yep. Absolutely.
to be that kind of voice of reason and a lot of stuff. But really it's where do you see this headed? What's your crystal ball say? Stuff like that. Kind of what things can we do within the portfolio to mitigate a lot of this?
Right. Or
Um,
what should we do,
or what
if
should we
anything?
do?
Yeah. Yeah.
Right. And so I think probably the one thing that I tell people the most is, yeah, we're constantly behind the scenes doing rebalances and taking in a lot of research, things like that. And there are, no matter if it's a really good market or a really bad market or whatever's happening in the world, there's always certain sectors that are kind of prompted to do better during certain times. And so I think a lot of people don't understand that's a lot of what we're doing behind the scenes, right? Is we're making these small adjustments to everybody's portfolios during this time to say, hey, this sector is probably going to do better during this time than maybe this one, right? And just kind of doing these little moves here and there. And over time, that really does make a pretty big difference.
Yeah, it does. In fact, I've seen a number of studies over the years that have talked about just rebalancing a portfolio.
Hmm.
And by that, what I mean is, let's say that you had a portfolio that was made up of 80% US stocks and 20% foreign stocks. And all of a sudden, maybe things get crazy like they have this year, and foreign stocks just start doing really poorly, right? And they drop a bunch more than
Yeah,
US stocks. So now instead of having 80-20, maybe now you're like 85-15. It could be that extreme. So a disciplined rebalance, as much as it might not feel good at the time, a disciplined rebalance actually means that you're kind of going back to your target, back to the 80-20, which means that you'd
absolutely.
actually be selling some US stocks and buying foreign stocks, if that was your actual target, right, to rebalance. So kind of simple example, but disciplined rebalancing actually, we've seen a number of studies that actually ends up resulting in a higher rate of return for investors over time versus never rebalancing.
Absolutely. Yeah,
Yeah.
the whole set it and forget it thing, not so much our thing, right?
Yeah.
So, but I think before we get into the slides, I just want to set out a reminder. So anybody who's live right now, please feel free to use the Q&A feature on the Zoom screen.
Mhm. Yep.
We there's only a handful of slides that we really do have here, so I think that part will be quick, but
Yep.
we'd love to take your questions. So please feel free to shoot those over as you think of them.
Yeah, absolutely. And yeah, the lawyers, of course, the compliance people tell us to say at the beginning that this is just our opinions. It's We because we don't know, and I think everybody gets that, right? When we talk to clients, well, try to predict when things settle down in Iran or the Middle East.
Right.
Never, right? I mean, we thousands of years, right? And
It's gonna be
it's
a while.
yeah, exactly. So you hit periods of relative calm. But I think everybody knows that, right? That when there's geopolitical stuff like this going on, nobody can predict exactly what's going to happen, or if there is a crisis, we'll go through a number of kind of different crises that have happened in the past. Nobody knows when it's going to end or when things are going to get better. So again, back to I'll probably overuse the analogy of the being on an airliner, if you're on a flight. Things get turbulent. That's normal, but sometimes things get really turbulent, right? Really uncomfortable. I mean, you're getting the puke bags out, right? And in some
Yeah.
cases, kind of like last April, we were doing one of these about a year ago, right now, when tariff announcements came out with the so-called Liberation Day and a lot of volatility in the market. I think the market was down almost 20% ish in a
Yeah.
very short amount of time. We saw even more of an extreme back in the pandemic, back in 2020 when the economy shut down. I think in a span of 3 weeks, the market was down, what, 30 something percent, very, very short amount of time. So that would be the equivalent of the puke bags coming out and just a huge amount of uncertainty. So it's natural. It's natural even for seasoned investors, even for somebody who's been on hundreds of flights or thousands of flights. Some of our clients have traveled almost for a living, right, with their careers at tech companies around the
Oh yeah.
world. There is no flight where there's no turbulence, and even somebody who's experienced a lot of it, it's still not fun. Nobody likes it, right? I mean, nobody would choose turbulence if they had the choice of a smooth flight. But that is exactly the trade-off, though, right? Is the smooth flight is not getting on the plane, basically, just choosing not to fly,
Just don't
and
fly.
that will be the equivalent of saying, you know what, I'm not going to be in the market. I'm not going to be in with any investment with uncertainty. I'm just going to park it in the bank, put it in money market,
Hmm.
something like that. Now, the trade-off, of course, is you're not going to Hawaii. You're not going to New Zealand. That's just not going to be a choice for you. And some people, that's okay, right? They just
Yeah.
say, then I'm not
They'd
going to
rather
New
just
Zealand,
not
and
move. Yeah.
yeah, I'm good.
Not take the risk, and
So.
there's that people.
Yeah,
Absolutely.
yeah, unless you start with an awful lot of money, right? If somebody just had a monster amount of money, they may not run out. And that really is the name of the game over the long run is don't run out of money when it comes to
Hmm.
retirement and financial freedom. Get to the point, first of all, where you've got enough money that it's able to have a very high likelihood of not running out. Certainly, so it kind of getting to that critical mass, but then don't mess it up, right? And some of how you can mess it up is by getting too low of a rate of return. We run retirement projections for people all the time.
Absolutely.
And if you're in investments, they have no inflation protection. Like if you were in a 100% bond portfolio or cash portfolio, that might feel more comfortable in the short run, but long term, those are investments that will not be able to outpace inflation. So if you ever kind of wonder, especially during times of volatility, is gosh, why do we even have to own stocks, or real estate? Real estate also is a pretty good long-term hedge against inflation. Why would I own these things that give me heartache and make me sick sometimes? And that's why, basically, because they're the
Yeah.
only asset classes that actually have a chance. We can't say guarantee, of course, uh, that have a chance of outpacing inflation over time.
Absolutely.
Yeah.
Yeah. So I think time to dive into the slides
Yep.
here.
Let's do it. Yeah.
Okay. So really what we are looking at here, let's see, there we go. So Josh, tell us what this slide is saying.
Yeah, so back to the 1940s, Pearl Harbor attack. We actually had, as a family, we went, I think it was 2 years ago, we went to Oahu and got to visit Pearl Harbor. It was actually pretty powerful to be there. But yeah, to kind of think about that happening, right? That attack. And of course, none of us were around. I think everybody was very, very few people, right, would have to be very old to actually remember that happening at this point. But, certainly a major, major world event. And you kind of wonder when there's an event that extreme, right? That disruptive, like a Pearl Harbor, a 9/11, or a pandemic.
Yeah.
So what we have listed out here is from 1941 to 2026, kind of a sampling at least of some of the, I would say, kind of some of the craziest things, right, that happened that were just extremely disruptive to the world economy. And the interesting thing is that for a long-term investor, for a short-term investor, if you're trying to trade and get in and out of the market, good luck with that. Right? There's nobody that I know ever, and Warren Buffett has said that as well, that he's never met somebody who can consistently time the market. Um, so these, how do you predict a pandemic, right? How do you predict a 9/11, unless you're involved in it? So it's just not something that's possible. But the interesting thing is that these shock events, as shocking as they are, and although it may cause a huge drop in the market in the short run, you can see after a month, 6 months, 1 year, that over those time periods, 60% plus of the time on average, a year from actually a month, the 6 months, a year from that point, you actually see that the market is higher than it was,
Yeah.
when the event actually happened. So obviously that means that the other, say, a third or 40% of the time, things actually got worse. So for example, after 9/11, the market actually was lower a year from that point. But it surprisingly, it wasn't because of 9/11 that it was lower a year from then.
Hmm.
It was because something else bad happened. And sometimes that happens, right? Is that
Yeah, you get
something,
those compounding events, right?
right?
That work together and just kind of domino.
Yeah, yeah,
Absolutely.
yeah. That was one of the worst kind of drops in the market that we saw, not only because that you had these bad events happening because they cascaded. In 2000, we saw
Yeah.
the tech bubble burst that year, and then 9/11 in 2001, and then in 2002, it had nothing to do with 9/11 or the bubble. It was actually related to the financial system.
Hmm.
In that there were accounting scandals. The big accounting firms basically were involved in cooking the books at some of these big companies like Enron, which no longer exists now, or WorldCom, another
Yeah.
company that doesn't exist anymore. They were basically cooking the books in the background, and of course that's highly illegal and unethical. And it kind of called into question. It wasn't just about a couple of companies; that also called into question the entire market. Then, how widespread is this? Is it Coca-Cola and Berkshire Hathaway, all these companies cooking the books, and we're working off of false information for earnings. So I unpack that a little bit just because sometimes, just because you have a bad month or 6 months or a year, that doesn't mean things can't get worse. Sometimes they get much worse
Yeah.
actually before they get better.
Absolutely. Well, and also to put it in perspective, so last week there was announcements. I think it was Friday, where the Dow and the Nasdaq officially hit correction
Mhm.
territory,
Yep.
right? 10% down.
Yep.
But we were on our forecast in what, January, and talking about the timing of this and how often that happens, which is happens to be about once a year,
Yep.
right? That the market hits that 10% correction territory. So even a year ago, like when we're looking at, so I think it's the third one down from the top on the slide, the tariff
Hmm.
announcements,
Yep.
right? That was about the same time that we had a correction last year.
Hmm.
But then you can kind of see how the numbers pan out. So just because something is happening, I guess the idea trying to convey here is that, in any at the time that you're feeling these events, right? They feel really big. And I think that's what most people kind of deal with is you're in the here and now and you're seeing what's happening right now. And you're kind of giving right now a lot of weight. But to kind of remember that, hey, if you have a financial planner and you have a long-term financial plan, your portfolio is probably, if it is diversified, is already set up to weather these storms. And I think that's a lot of what I've been having conversations with clients
Hmm.
about is that you're already diversified. Your portfolio's literally built for this stuff. Doesn't feel good during the time that it's happening, but it's meant to outlive this stuff.
Yeah. Yep. And I think over the long run, as long as somebody's diversified. Now, if you have all your money in one stock, again, think of like an Enron, which was terrible back at the time because a lot of Enron employees actually, not only did they own a lot of Enron stock personally, but back then they actually used to let 401k participants put all their money in their own company stock in the plan.
Don't do
So horrible. No, you can't even do it anymore. But back then though you could. And so not only did they
Yeah.
they lost their stock went to zero, their 401k went to zero, they're out of a job, they lost their health insurance. So that truly would putting all your eggs in one basket by putting it all in one stock or even one asset class. Really putting all your money in
Yeah.
tech stocks or all into energy stocks into one area. That's not wise either. So staying diversified, I think, is kind of key so you can come back to fight another day. And I think that's really the point of the slide, really, is the 1 month, 6 month, 1 year. Not that there's a guarantee, but there's never been a time that there wasn't a correction or a bear market or a recession. There's never
Hmm.
been a time in history, not to say it couldn't happen, right? We can't guarantee things, but there's never been a time where things didn't come back, in other words, and eventually go higher, actually, than than they were before. So I think it's just a good reminder, to all of us when you're going through a period of volatility. You're on the airplane, things get turbulent. When you land in Denver, almost every time, right?
Oh
You
yeah.
can predict it. I mean, the landings in Denver are terrible. The air is choppy. Doesn't feel good no matter how many flights that you've been on. But a good reminder, if you start getting panicky, it's like planes don't crash because of turbulence, right? It's just really uncomfortable.
Yep.
We actually have a couple of clients that are airline pilots. So it's kind of interesting talking to them sometimes. It's like up in the cockpit, when things get turbulent, do you guys get nervous? What do you do? And they don't, and that's their job, right? Is they do it all the time. So kind of back to your point, right? Is
Yeah.
that, we're the equivalent of your pilots in the cockpit, right? Is that we've got a plan. We've spent time. We talked about risk with you, certainly the risk budget that we kind of had, and every client's different, right? Everybody has a different risk number. But if you have a well thought out plan, you're very diversified. Really, when things are crazy, that's not a time to just throw the plan out the window. That would be the equivalent of kind of going like, oh, let's put it all in cash, let's put it all in gold, let's put it all in the backyard, right
Right.
in a hole. And
Yeah.
sometimes it's interesting during times like this when the market's volatile, friends or family, they probably say this to you, oh, I bet things have been really crazy at work. I bet, clients are freaking out. And that's not, we're certainly not
No.
experiencing that right now. We didn't even last year, even when the market was way down.
No, I don't think so at all. And I think, I give a lot of credit to our clients on that. I think most of them have been around or been in the market long enough where, they've seen these ups and downs. They've lived through most of this stuff on this list right now,
Mhm.
right?
Yeah.
And they've seen what it does over the long term.
Yep.
And so, good job, clients.
Yep.
Keep that stuff up.
Yep.
That makes our
Absolutely.
lives easier.
Yep.
But
Your
doesn't mean
keep
you're
your
not
seatbelt fastened.
right.
Uh,
Doesn't mean you're
yeah.
not having those semi-emotional conversations and
Mhm.
things, and
Yeah.
with people in meetings, which is perfectly fine.
Yeah, and I think the other key there too is time, remembering how much time do I have until I was going to touch this money anyway. Now, if you
Mm,
needed all your entire portfolio like next month, right? I mean, you were going to cash it all out and go buy, a house or something like that. Yeah, I'd be nervous. I mean,
yeah.
that's not good. You shouldn't be invested in the market
Yeah.
if your time frame
That's
is
a whole other thing.
is truly that
Mm,
short term. But I mean, really, for most clients, though, their time horizon actually is certainly years, if not decades, right? That they're planning on taking
mhm.
that money out just in little pieces. So as you're accumulating, and for those of you who are still working, actually, yay, actually, volatility is great because as your dollar cost averaging in and putting money into your 401k or your company stock, whatever that is, dollar cost averaging means that you're getting an average price of the market or the stock or whatever it is that you're putting your money into. So as odd as it sounds, market drops actually are really good for your new money, at least that you're putting in.
Absolutely.
But even for our clients that are retired and drawing money out, yeah, it doesn't feel as good, certainly, when volatility happens and things are down and I'm taking money out, but we're only taking little pieces out, right? There's a monthly amount that might be deposited in your checking account, but
Yep.
not the entire portfolio. So I think it's important to recognize too, what's my true time frame?
Absolutely.
Yeah.
Absolutely. Yep. And then, of course, the other slide we have. So, kind of how the market really just climbs the wall of worry, right? So, this is very similar to that other slide. It just gives us a little bit better visual of what the market's actually doing during these times, both before, during, and after. And I really like this. So, this is a very simplified slide of something that we've used in the past, the Morningstar Index
Mhm.
chart. Really cool. If anybody ever wants to see that, just let me know. I love that thing. But yeah, I mean, you're looking at some major things on here, right? And when they happened, they felt again super important at the time. But as we go on, again, on that long enough time frame, they're all just kind of bumps in the road.
Yeah. Yeah. Even something extreme like COVID shows up there. And for those of you who are just listening and not watching, you see the jaggedness, right, of the market over decades.
Hmm.
But you look at COVID, it was a pretty big drop, right? And certainly
Yeah.
there were lasting effects on the economy, on how we live, we DoorDash. I mean, all the ways that we kind of go about our lives. But
Absolutely.
I think kind of the moral of the story, though, is that yes, there are extreme things that happen, but eventually we figure it out, right? That we, as a people, figure it out, and people adjust and they move on. So that's not to minimize any of the heartache that any of these things happen, whether it be war or pandemic or 9/11. Obviously, extreme emotional events as well that affect people's lives. But I think the moral of the last slide and this slide is that yeah, that stuff happened. It was bad, but time passed, people figured it out, we moved on,
Hmm.
and from the market standpoint, companies, you think about down to the individual company level, think about Apple or Walmart or Conoco. These companies are still producing the service, a product. They're still profitable. They're not
Yeah,
disappearing, no
absolutely.
matter what and in some cases, they're able to take advantage of it. Think of energy companies right now. Those have been actually some of the best performers over the last month, right? Because oil prices have spiked, their profits are expected to go way up,
Yep.
especially if oil prices remain elevated for a while. So again, should you put all your money in any one sector, one company? No, but just because something bad happens doesn't mean that companies in some cases actually benefit from it, or at the very least they're adaptable, right? They're gonna
Yeah,
they're gonna
I think
adapt
that's a
to the
good way to put that.
circumstances. Yeah.
Yeah, really companies just want to, I've had this conversation with clients a lot too.
Mhm.
So, um, whatever's happening politically or economically in the world, companies are really good at pivoting,
Yeah.
right? All they got to know is a direction to point. What happens is kind of like we looked like about a year ago when tariffs were announced, there was all this volatility, right? I think for the most part, because a lot of these companies were trying to digest what all these tariffs meant, they just need a direction to point,
Mhm.
right? They just say, okay, we know what this means now, we can point in this direction. And they're very good at adapting. And so it just takes a little bit of time, but it's that short-term volatility that everybody kind of freaks out about and is just causes some undue
Yeah.
emotional
Yeah,
states.
again, choppy air.
Yeah,
A good pilot. You could be the best pilot, the best aircraft ever. Still going to be turbulent, but they adjust accordingly, right? I think
yeah,
experienced pilots going to be adjusting their approach, to the runway. Certainly as they're landing, they'll do what they can. I mean, when you talk to pilots again, it's like, what do you do about turbulence? They don't really care, right? I mean, it doesn't
yeah,
bother them in the cockpit. But I mean, do they care about the passengers in the back? Yes, that is part of their job is to try to make people as comfortable as possible. Do they try to change altitude and adjust their approach? Ultimately, it's about safety, though, right? It's about
yeah,
we're trying to get where everybody wants to get to their destination safely. And again, they can't guarantee anything anyway, no matter how good their training is. So they're also operating in an environment of uncertainty. And as financial advisors, that's one of the challenges, and as investors too, right? For all of our clients, that's part of the challenge is that you're operating in this environment of uncertainty. But that's kind of life, right? I mean,
yeah,
life
absolutely.
you even just personally, right? We all are going to be navigating good stuff, bad stuff, but there's still a right and a wrong way to react, right? And
Yeah,
yeah, I think what you said, adaptability is huge.
absolutely. Absolutely. So, that's all the slides that we had. We just wanted to give you guys some visuals on a lot of this
Mhm.
stuff. Obviously, our disclosures, everything we're talking about is, of course, our opinions,
Yeah.
right, for a lot of this stuff. But I wanted to we got a couple questions going on
Yeah,
here.
let's do
But
it.
I think first and foremost, Josh, what do you see are, the common mistakes in times like this that investors make?
Yeah, it's a good question. Probably the biggest mistake that I see people make is that when things get crazy, they glue themselves to the news. And you have
Hmm.
to remember that the news, I'm sure they're good people in the media, right? Not to attack people personally, but they're in the business of eyeballs and clicks. By that I mean is to keep you watching, to keep you clicking. So that means that everything that they're putting out there for all of us, right, is there to kind of disturb us, right, and
Yep.
scare us. So almost everything you see, and it doesn't matter, liberal, conservative, middle, it's all built to do the same thing essentially, because that's what they're in the business of is advertising, right? And the longer they can keep you there, the more that they're going to make as far as money. So being cognizant of that, if watching the market all day long, whether the market's good or bad, if you're watching the market all day long as an investor, you have to think, is that really doing me any good? or is it actually
Mm,
raising my anxiety level? And I think for most people, it's actually going to be raising your anxiety level. I'd say the same thing with the news, not to say that you should just be ignorant, right, and not knowing what's going on in the world. But there's a difference between being aware, right, and having some idea of what's happening and being glued to the TV all day long or glued to the internet all day long. Again, it's designed to make you anxious, and us anxious is just a human thing.
yeah,
And I think that's probably the biggest mistake. And the second mistake would be acting on it, right? Because when things get crazy, of course, they want to make you scared. And there's a difference between being scared and then doing something extreme, right?
yeah,
Back to my airplane example, taking off the seatbelt, trying to open the door mid-flight, that would be insane,
that
right?
would be terrible.
But as an investor, that is what happens sometimes is that if people just get their emotions worked up too high, sometimes we don't see it happen often, but sometimes people will take a well-diversified portfolio and they just kind of get so worked up about whatever the thing is that they think that the world's going to end and their money's going to go to zero. And, it's kind of this vicious cycle until the point where they say, all right, uncle, and they want to cash out and go to, you know, a, money market or CDs or something like that. And of course, it's your money, right? And we're all going to make those decisions. But the reality is that, like the slides we went through before, that is not often going to be a good decision, certainly over the
Yeah.
long run, because even if you knew when to get out, how are you going to know when to get back in? Even if you could predict the pandemic, right? I mean,
Yeah. And
if you
that's,
had gotten out, when would you have gotten back in? Because things were much higher actually a year later. So would you have actually known when to get back
and I
in?
think we've seen that,
Yeah.
right? We've actually seen that in practice is that when someone does freak out, now luckily it doesn't happen a lot, but
Mhm.
when someone does, that's the hardest part
Yeah.
is timing that. When do I get back in? When do I buy back in? Because there's always something,
Yeah.
right? There's always some concern in the market, or this is leading to that, which is leading to that, which makes buying back in the hardest part. And we've covered that stat previously in other webinars and things like that of those some of those biggest days in the market when you're getting some of the biggest gains typically happen right after those really bad things
Yep.
happen,
Yeah.
right?
That's true.
And you're not going to participate in that
Yeah.
if you're not in the market because chances are you're not going to be bought back in at that time.
Yeah. One of the cardinal rules of investing is buy low, sell high, right?
Yeah.
But your emotions are not going to tell you to do that
Yeah.
at the right time anyway,
At the
right?
right time.
Because
Absolutely.
buying in right after 9/11, in other words, is not going to feel good, right?
Yeah.
Or right, as the pandemic's hitting, because of course it's easy to kind of extrapolate that in your own mind that, oh my gosh, the market's down 10, 20%. It's going to go down 80%, before, the
Absolutely.
things bottom out. Again, we can't do it either. It's not like we know exactly the timing of any of these things. So, yeah,
Absolutely.
that's a big mistake. I think as people that and finally too, not understanding to begin with, not understanding the risk that they're taking in their portfolio. Sometimes people are just way too aggressive, for what their comfort level is, but they
Hmm.
don't know it. We see this happen sometimes, especially over the last few years, where tech stocks, a lot of AI related stocks, have just been a rocket ship. And sometimes people get overexposed to individual companies or even just a sector and not realize that we are going down the highway at 99 miles an hour and not realizing the risk that they're taking. And so, of course, the losses that can happen on the
Yeah.
other end of it, are could be catastrophic, could be permanent, right? In some cases. Yeah.
Absolutely. Yeah, it's really easy to be high risk in good times.
Yeah. Yeah.
But
Yeah.
yeah,
But
that's why honestly, that's why I think kind of things like corrections, things like that are
Mhm.
probably the best times to be having that risk conversation
Absolutely.
with
Yeah.
clients because like how do you feel right now?
Yeah.
Because that's probably more your risk tolerance in
Yeah.
all reality.
Yeah. Risk numbers. Every client has a risk number that when we spend a lot of time talking with people, and it can
Hmm.
range from 1 to 100. Right. Most people are kind of in the middle, someplace, right? It being some kind of a balanced mix and diversified. But again, spending that time up front to know that what does a typical bad day or bad month or bad year look like in a 60-mile-an-hour portfolio or a 30-mile-an-hour portfolio.
Hmm.
Yeah.
Absolutely. So yeah, so we got a couple of good questions here. Um, so we have one, I love this one. Which asset classes historically perform best during periods of geopolitical instability? Do you think that pattern still holds true in today's market environment?
Yeah, it's there's well the easy answer is we don't know, and there's not something consistent like gold, for example.
Right.
Sometimes people kind of have that in their mind that well, gold tends to perform the best during times when there's a huge amount of uncertainty, and sometimes that's true actually.
Yeah.
Yeah,
No, that's a good point. So there's not a 100% correlation, I would say,
hmm
on any specific asset class.
yeah,
I would say there are some asset classes that tend to do better during like war times or things like that.
yeah.
It's not a 100% correlation. Yeah, but
Yeah, it depends on what the crisis is, right?
yeah,
Right now, it's energy stocks, defense stocks are doing really well, right?
yep.
And the stocks that have gotten hit the hardest probably are software stocks, specifically in the tech sector.
hmm
Not necessarily related to Iran, right? But actually more fear of disruption from AI.
Yeah,
Yeah, so
absolutely.
it's hard to look at it exactly, but I mean, cash is the most boring asset class, right? That's just money deposited in CDs, money markets.
Yeah.
You go back and look at really extreme times like 2022. You actually saw stocks and bonds. So bonds aren't always the answer either. Stocks and bonds go down. You look at the financial crisis. About the only thing that actually held its value is cash equivalents or short-term treasuries.
hmm
So stocks of every flavor drop. Real estate dropped, right? Because that was the point of the financial crisis, right? Was real estate value. So
Yeah.
that wasn't a safe haven. Even if you owned individual rental properties, sometimes people think that, well, that's the answer, is if I have a bunch of rental properties. Well, what happened in the financial crisis, right, is that you had mass vacancies. And so you could be sitting on properties that are dropping in value with no renter, or your
Yeah.
renter trashed the place, right, before they open the meth lab in the basement. I mean, there is no risk-free investment for sure. But
True.
yeah, diversification. I know that's um, maybe not a specific answer, but just being really diversified, having all the sectors covered because it's so unpredictable. What's actually going to happen.
Yeah, and that kind of leads into honestly, there's a couple other questions that are very similar here, so I'm going to try to tackle those.
Mhm.
So,
Good.
how are we adjusting portfolio allocations? What kind of rebalancing have we done? So yeah, so there is no 100% correlation, I would say, but we get a lot of research from a lot of really big places, right? People that spend billions a year on market research. And the thing is that it does shift and it can shift pretty quick,
Mhm.
right? Which things are doing better, which things maybe not so much. And so behind the scenes, a lot of time, at least here at Keystone, we're constantly taking this into account. We have software that helps us out and puts all this, very simply put, recommendations from various money managers saying, hey, this is kind of what we're thinking here. We have an investment committee that meets pretty regularly that kind of discusses all of this stuff as well. But I would say that's a lot of the time what we're doing behind the scenes is taking in this research. It's very real time research
Yeah.
as well that's happening all the time, and then kind of making those small tweaks to people's portfolios again, highly depending on that risk score.
Yeah.
So
Yeah, absolutely. So yeah, we definitely pay, it's not just us. We pay attention to the largest institutions in the world, Schwab, Fidelity, BlackRock, Morningstar, and others. So we're certainly using their expertise as well. And yeah, as far as adjustments, I call it more adjusting like a cruise ship versus a speedboat. Right. You're never going to see, at least at Keystone, you're never going to see the extremes where all of a sudden we've gone 100% to gold or cash or something like that. These are going to be
mhm.
kind of micro adjustments in a portfolio, but that's how we're measuring the experts, though. Say if we're getting research from BlackRock or Morningstar, that's what our investment committee is doing too, is looking at, well, how are they doing, right? What's their track record? How are they doing
Yep.
against the rest of the market with their own recommendations? So, and certainly because we're independent, we're not married to any of them, right? And so
Yeah.
it's our job to basically be a good steward of assets. That's what a fiduciary is, right? Is that you're here to look out for your client's best interests, and so certainly that's something we take very seriously.
Yeah. Absolutely. So here's another one. So this one, JP Morgan News today, kind of talking about an economic time bomb, right? So mostly this is surrounding global oil reserves, a lot of the uh, uncertainty around that. So this is kind of a two-part in my mind,
Hmm.
I would say, is that this is where kind of I know Josh has said this many a times is guard yourself, right? So
Yeah.
no matter where you get your news, um, there's a lot of articles out there and you're going to get hit with it every day. And that's the thing about modern technology now. You know, you have it on your TV, you have it on your phone, you have it on your computer. And all of these things are coming in. And so depending on where you're getting your news, not to say, you know, every news outlet is bad or anything like that, but just know that every news outlet is also trying to sell you,
Yep,
right? They're
they are.
trying to say, hey, pay attention to what we're saying because what we're saying is really important and forget about the other guy,
Yeah.
right?
And even the experts can be wrong and oftentimes
And
are.
oftentimes
Yeah.
are.
And they might be right. Sometimes they're right.
Yeah.
But using JP Morgan as an example, and not to knock them at all, but Jamie Dimon, is their CEO, has been
Hmm.
for quite some time, biggest bank in the world. So yeah, you would certainly want to listen to what they say. But Jamie Dimon specifically, though, I think it was back in 2023, was predicting a recession, catastrophic drop in the world economy. And if you had acted on that, in other words, and just gone to cash and sat on the sidelines, you would have missed out in 2023, 2024, 2025,
2025.
one of the best stock market runs of all time. And this is the guy running the biggest bank in the world, right?
Yeah.
Supposedly one of the greatest financial experts, and he was dead wrong. So he might be right this time, right? JP Morgan might be,
Yeah.
but it's always good to kind of think about that is that the experts, even the president, the Federal Reserve, even the people with all the information supposedly, like in the financial crisis, you think about that. Again, these are supposedly the smartest people in the country and the world running the economy, and they let that happen,
Yep.
right? So,
Yeah. And
yeah,
I think, and to kind of get into this. So yes, you know, there may be something to a lot of these things. Is there concern about oil? I think a lot of that largely because of what was going on with Iran. Yes, obviously that's impacting
no,
supply lines
huge, yeah.
big time for a lot of that. So yeah, that's some genuine concern to have. But really, again, I think a little the best thing you can do is stay diversified, right? It's not
Yeah.
like um, that we don't want 100% of everything to be in oil, right? That'd
Mhm.
be really terrible.
Yeah.
Probably look really good right now
It would.
with where oil
There's
prices
but
are.
there's boom and bust cycles there too, certainly.
Absolutely.
Yeah.
But really I think kind of going to the point here is your best bet at any given time is still just stay diversified. Yes, there is a little exposure in your portfolios to oil. There's energy in there. Unless of course you're probably ESG, which there probably wouldn't be a lot of in there either.
Yeah.
But if it is a genuine like concern, like I might not have enough cash. A lot of the times, I think what we do with clients is say, hey, if you are genuinely concerned, instead of selling out or instead of, you know, being really drastic about something, let's just talk about how much cash you think you're going to need for the next 6 months, 12 months, right? And then if that's the case, we say, okay, well, here's what we're going to do is we're going to take that cash and we're going to set it aside. And so then you can let your portfolio ride the wave for the next 6, 12 months. You don't have to worry about it because you know that you have the next 6 to 12 months covered,
Yeah.
right?
Yeah.
So again, I don't know that we've used that approach in the past when things are really, really crazy with really, really emotional people. Um, Not necessarily the most suggested way of doing it, but it is a better way than saying, I just need to get
More
out.
than just sitting in cash, or are you cashing out a portfolio?
Yeah.
Exactly. So again, I think a lot of it comes down to time frame, and even if JP Morgan is right, and there's some huge disruption that happens this month, but if we're talking about planning for decades, though, back to our mountain chart, right? I mean, it might be one of those blips, it might be one of those extreme blips, but still, it comes down to, but would you be able to time it correctly as far as
Yeah.
knowing, okay, even if they were right, and then knowing when to get back in, not likely that you're going to be able to do that. So
Yeah,
very, very
absolutely.
human, very logical, uh, way of thinking too. But again, I think it comes back to kind of short-term thinking versus long-term thinking. And as certified financial planners, of course, we're thinking long-term. We're thinking of, how do
Absolutely.
we cover today's needs, right? Certainly from a cash flow perspective, right? But really planning for a portfolio over the long run.
Yep. Yeah, and then our current last two questions here are around AI, actually. So it
Yeah.
has not left the conversation.
No.
I like that. So yeah, how do you differentiate between AI companies with sustainable competitive advantages versus those benefiting from short-term hype cycles? That's a
Yeah,
great
that is a
question.
good
I like that.
question. Yeah, Morningstar. Actually, I think it was Warren Buffett originally that coined the term economic moat. That companies that are a very wide moat company tend to be one that kind of like a castle, right? That you might have a moat around the castle. If you have a really wide moat, well, that's a good thing, right? If you're trying to defend against the invaders,
Right.
versus if you have a company that has a narrow moat or no moat, they're at much greater risk. So that's one of the things we do lean pretty heavily, of course, on our experts, at Schwab and Fidelity and BlackRock and so forth, to be helping guide what companies people should have exposure to. But that's the best answer I can give is that certainly adaptability is going to be huge when you see changes happening as quickly as we are right now.
Hmm.
But also looking back to companies, they have a wide economic mode around themselves. Do they have a competitive advantage? In other words, are they profitable? And in a lot of cases, many of these companies are extremely
Yeah.
profitable right now. That's a big difference of maybe comparing against the dot coms. So a lot of people are comparing the AI companies to the dot coms of the late 90s. Most of the dot coms never made any money, right? They never
Yeah.
even generated a profit, yet their stocks were going through the roof. Is there some of that maybe with some of the smaller AI companies or newer? Yeah, I'm sure there is,
Hmm.
absolutely. But there are a lot of companies making huge amount of profit right now.
Yeah, I would say another way that we do that as well is that even with our exchange traded fund models, I've noticed over the past year, year and a half, maybe a little bit longer than that, the addition of AI infrastructure ETFs.
Hmm. Yeah,
So not necessarily buying up those specific companies, but basically buying the AI index, as it
yeah,
were. So diversified way of doing it, but you're participating in it. And, the actual companies who are doing it, that's left to very much smarter people, right?
yeah.
Or
You're buying the
more
exposure.
actively on there. Yeah, you're
Yeah,
buying the
yeah,
exposure.
yeah.
Exactly.
As versus just making a big bet on one company. Yeah, and again, especially right now, I think that's important because there might be the highest, Nvidia or whatever, right? I mean, might be the highest flying company, and they might be for a while. But every company has its day in the sun in any sector, in
Absolutely.
any company, and over the long run, Jeff Bezos actually told this to his employees not that long ago, right, at Amazon. He said it as successful as we are, Amazon someday will not be here. There will be some day where Amazon, or at least we will not be on top.
It's a
Kind of,
crazy thought.
yeah, hard to even think of that just
Yeah.
because of how much it's embedded in our daily lives. But he's right. Given enough time,
Yeah.
how many companies can you point back to that existed 100 years ago, 150 years ago? Not many. I mean, there are some, right? There are
Right.
some, but they're probably a shadow of what they once were.
Absolutely. All right. So then our last one, and this is a good one too,
Yeah.
is Keystone leveraging AI to help manage or direct portfolios.
Yeah, certainly in the research, there's no question.
Right.
With research analysts, which is not us, by the way, this would be people at the big companies like Fidelity and Morningstar and so forth. Are they using it to crunch numbers? Absolutely. Right.
Hmm.
There are things that can be done now that used to take somebody probably hours and probably took a lot more people, frankly, too. So a research analyst is still an occupation, right? It hasn't gone away completely, so the robots aren't controlling everything. There's still human judgment involved, but are they certainly leveraging that to be able to crunch numbers, pull summaries of research reports, earnings reports, things like that? Absolutely. So,
Yeah.
yes, there's always going to be some technology advantage there, but at the end of the day, you do want a pilot in the cockpit making that judgment.
Yeah, I'm glad you actually
So,
said that.
yeah.
So, yeah. So, are we leveraging AI as Keystone and Company? Yes. Are we leveraging AI to manage or direct portfolios right now? No.
Mhm.
That's still very much hands on us.
Yeah.
I would say we use AI a lot, like Josh was saying, in the research department, pointing us in specific directions, things of that, digesting a lot of data. It's very helpful for that. Which let's face it, there's a lot of real-time market data that's happening all the time around us. So it's a powerful tool for that, but not directly managing portfolios. We are very much involved with that still.
Yeah, and as a company, we're getting a lot more efficient as most companies are right now. And if you're not, you're going to be in trouble, I think. You're not going to be able to keep up. In other words, just as far as how do we manage workflows, how do we manage, just how we kind of operate as a company. But this is very much still a human business. And at the end, I mean, fast forward 20, 30 years, maybe more and more stuff will be automated in the world. But I think that's where, we still, for the clients who work with us and trust us, where I think that's the primary thing that you're getting, right? Is you're getting somebody who cares, first of all, that actually knows you, and that they've
Hmm.
got a vested interest in helping you succeed, which again is that fiduciary aspect. So we appreciate the relationships, of course, that we've got with all of our clients, and that's the best part, really. I mean,
Absolutely.
of what we get to do is have a big impact, but in a very human way, right? As far as how we're connecting with people.
Yeah, absolutely. So that is all of the questions that we had on there so far.
Yeah.
Any parting thoughts? We
Yeah,
are
a
coming
couple of
up on our time.
Yep, couple quick quotes. Warren Buffett, of course, he's still out there, by the way. He's now stepped down from his CEO role, but he's still chairman, right? So
Yes, he
he's
is.
still working at 95. Maybe I'll be here at 95. We'll see. But one of his famous quotes that he's says frequently actually is, "Be greedy when others are fearful, and be fearful when others are greedy."
Hmm.
And I think that's not a shouldn't be taken as a market timing comment at all. But I think it is kind of instructive that what he is saying is that when prices are low, that means that everybody's scared. And when you look at that mountain chart again, we were showing before, those would have been the best times to invest, right? When
Yep.
everybody else was fearful and stocks were really cheap. And when everybody else is greedy, especially if there's something that has just gone through the roof, and who knows what it is at any given moment. Maybe it's AI, maybe it's gold, maybe it's .com stocks and or real estate, the real estate bubble that we had in the 2000s. It's not to say that you shouldn't have exposure to some of these areas, but when there's kind of a mania, it should be a little bit of a warning sign, right, to not get overexposed to that one thing. And so we are very cognizant about how we're managing portfolios. In the second quote, Bill Ackman, who manages a lot of money and is out there in the media quite a bit, but he says high quality businesses are trading at extremely cheap prices. And we've seen a good market jump here the last couple of days. So maybe not as cheap with certain companies, but there's always an opportunity. And certainly when there's been a sector or a company that's gotten hit, that again is where the research comes in as far as maybe that's a time to get some exposure to that.
Hmm.
Right. And so there could be really high quality businesses. Right now, an ugly duckling for sure is software companies, software, tech
Yeah,
companies
it's true.
have really gotten hit here recently. And some of them may not survive. Back to the question that was asked about AI, um, right? Is that some of those companies may not, if they're not able to adapt fast enough, they may go away. Even a big company like Microsoft certainly could be massively disrupted. So, yeah. So basically, this is about time in the market, not timing. I think that's kind of the key is when you get to
Yeah.
a time like this where you start feeling a little sick to your stomach, you're feeling the bumps. Recognize what it really is, right? And recognize that, hey, this is long term. This is a planning process. This is not about just what's happening right now, and that there is a right and a wrong way to react. So, with that, we just appreciate you, appreciate our clients, appreciate our team. We are here for you to answer any questions when times are volatile or when they're not. Either way, of course, we're here for you. But yeah, we wanted to reach out today. We thought there's some bumps. We're up in the cockpit, and
Yep.
yeah, we can tell people might be a little bit nervous in the back. So we did want to reach out. But yeah, thank you so much. Again, thanks for your support and have a great week.
Absolutely. Take care.